Hello, everyone. The purpose of this video is to give you a refresher on adjusting journal entries. So I'm going to explain the theory behind it, and then I'll go into specifics regarding your homework assignment. So without further ado, let me go ahead and share my screen. I'll start my presentation here. Okay, adjustments explained. QuickBooks can be set for either accrual basis accounting or cash basis accounting. So let me just briefly explain to you the difference between accrual basis accounting and cash basis accounting. In accrual accounting, revenues are recognized when earned. It doesn't matter if cash is received or not, right? So likewise, expenses are recognized when incurred. And incurred is a special word for meaning it happened. So an expense happened, you record it. It doesn't matter if cash is paid. And because of this accrual accounting, we have these adjusting journal entries. Now, you can work on the cash basis. And, you know, cash basis is very simple because you can only record revenues when cash is received. And you can record expenses only when cash is paid. Now, cash basis of accounting is not in accordance with generally accepted accounting principles. That's GAAP. So you say, well, Tutrip, if it's not GAAP, why are you telling me this? Well, there are instances where you will be using cash basis. For instance, when you prepare your tax return, you're on the cash basis. So unless you actually pay the expense, you can't deduct it on your tax return. But likewise, you only have to report revenues that you actually received in cash. So tax return is on a cash basis. But the bottom line is that QuickBooks can be set up for cash basis accounting or accrual basis accounting. But we're going to do accrual basis, right? Because it's GAAP, and that's the reason why we do adjusting journal entries. Well, let's go ahead and explain what adjusting journal entries are. Adjusting journal entries are made to ensure that revenues are recorded in the period earned and expenses in the period incurred. In other words, when they happen, okay? They're necessary because the trial balance may not contain up-to-date and complete data. So if your trial balance is not complete and has the up-to-date balances, that means your financial statements won't be correct. So adjusting journal entries are required every time a company prepares financial statements. Adjusting entries make it possible to report correct amounts on the balance sheet and on the income statement. Matter of fact, to be an adjusting journal entry, you've got to at least have one income statement account and one balance sheet account. Now, most revenues and expenses are recorded through the accounting period. For instance, you paid a telephone bill. Yeah, debit, telephone expense, credit, cash. However, some revenues and expenses must be recorded at the end of the period. Examples would include supplies used. Yeah, when you buy supplies, you're going to debit the asset supplies, but there's no invoice saying, hey, you use that ream of paper, and hey, use those paper clips. So we have to figure out how much we use and make an adjusting journal entry to show that we don't have those supplies anymore. So we reduce the asset and we increase the expense, supplies expense. Likewise, for an insurance policy, when you buy an insurance policy, you own that policy, right? So it's an asset. So you debit the asset. Now, there's no invoice that you received saying, hey, man, you just expired 1 month of your insurance policy. So what you have to do is, the accountant has to figure that out. Well, if we need to expense 1 month of that insurance policy because it expired, well, that's what we do through adjusting journal entry. Let me go ahead and explain this in an example. Let's say that the trial balance on October 31 shows supplies balance of $2,500. Now, if we stopped right here, we would put supplies of $2,500 on the balance sheet. But at the end of October, we counted only 1,000 of supplies on hand, right? So our balance needs to be 1,000. Well, what happened? It was 2,500, but we ended up at 1,000. Well, we used 1,500 of it, right? So what we need to do is we need to reduce our supplies account, right, by 1,500. And basically, we used up the supplies. Then we transfer that cost from the asset supplies to supplies expense. So our journal entry would be debit supplies expense of 1,500 and credit supplies for 1,500. Okay. Now, another example would be expired insurance. On October 4, we paid $600 for a 1-year fire insurance policy. Okay, so when we buy the policy, we own the policy, so it's our asset. We're going to be debiting prepaid insurance by $600. Now, at the end of the month, October 31, we have 1 month of expense, one month of insurance policy that expired, and that's our expense, right? And how much? Well, if it's a $600 policy over 12 months, it expires $50 a month. So we're going to record 1 month of expired insurance. How do we do that? By crediting our asset prepaid insurance. When that's expired, then it becomes insurance expense. So we debit insurance expense. So what's our adjusting journal entry? Debit insurance expense, 50. Credit prepaid insurance, 50. Now, once you do that, everything is great because, we start out with 600, we use 50, and we still have $550 of that policy that we can use in the future, right? So that's how it works. Now, there are 4 types of adjusting journal entries. 2 of them are called deferrals, and 2 of them are accruals. And I know I'm going to do this quickly because you have already learned this in financial accounting. And I wanted to share this with you because when we do it through Mookie, the Mookie way, it's a little bit different. So I want to show you what you know, and then match that against what you'll be doing for Mookie. But anyway, a prepaid expense, well, basically you originally recorded an asset. And then as you use up that asset, it's expired and becomes an expense. So just remember, prepaid expenses like prepaid insurance or supplies, you book it as an asset. And then when you use that asset up, it is expired, it becomes an expense. Unearned revenues, you originally recorded as a liability. And why is it a liability? Because you receive a cash advance. But the thing is, you receive the cash advance and you receive the money, but you haven't done anything for it yet. So until you do, you owe it. So you're going to be crediting a liability account called unearned revenue. Now, when you finally earn it, like you do what you say you're going to do with the money, well, then you can release the liability and record the revenue. So this is what's kind of interesting. Prepaid expenses, you originally recorded as an asset. Unearned revenues, you originally recorded as a liability. Then you have the accruals, and these are pretty easy, I think. Accrued revenue. Well, here you earn the revenue, but you haven't received cash. Well, it doesn't matter if you receive cash or not in the accrual method. So if you earn the revenue, you've got to record the revenue. But what do you do if you didn't receive the money? Well, it'd be some type of receivable. So let's say you earn some interest. You would debit the asset interest receivable and credit interest income. Now, as far as accrued expenses, those are expenses incurred, but not yet paid in cash. Even if you didn't pay them, it doesn't matter on the accrual basis. If it happened, you have to record it. A classic example of accrued expense would be your employees. Let's say that your employees work for you, so you incurred some wages expense, right? But you haven't paid them. Well, what are you going to do? Well, you're going to debit wages expense, and but you haven't paid them yet, so you're going to have to credit wages payable. So that's kind of how it works. Now, let me give you some concrete examples of what I'm talking about here. With prepaid expenses, I said that you originally record as an asset, right? So when you do supplies, you record the asset supplies, in this case, 500, and you pay cash for it, okay? Well, at the end of the period, you may use some of those supplies up. In this case, we used 100 of those supplies. We bought 500, and so they're in the asset, but we used 100 of them. So we have to take it out of our asset supplies, and when we use them up like that, that cost is transferred from the asset to expense. Sometimes expense is called expired assets, and that's kind of where they get that, right? So you're going to reduce reduce your asset and record the expense. Okay. Now that's the prepaid expense. Let's do unearned revenue. Here you originally record the amount as a liability because you received money in advance, right? But you haven't done anything for it yet. So you receive the money, you debit the cash, that's the cash advance. But because you haven't done anything for it yet, let's say maybe you received $500 to prepare somebody's tax return. Well, you haven't done the tax return yet. So until you do, you owe that money to that client. So you credit the liability unearned revenue. And then let's say that you did some services and you did earn $100. Well, now of that 500, you can release that liability for 100. So debit unearned revenue, which reduces the liability by 100, and then you earn the service revenue. Okay. I know I'm going quickly, but like I say that this is review for you. Okay, now we're doing the accrued revenues and accrued expenses. Remember, accrued revenues are revenues earned, but not yet received in cash. So you earned it. So let's say you earn some interest. Well, you're going to credit your revenue interest income. And even though you haven't received the cash, it doesn't matter. If you earned it, you record it. But so what you'll do is you'll put down interest receivable of 1,000 because you are owed that money, right? Likewise, you have accrued expenses. Those are expenses incurred, but not yet paid in cash. And I was telling you before that the classic example of that would be your wages of employees. So let's say your employees work for you and you incurred wages expense of 500, but you haven't paid them yet. Doesn't matter if you paid cash or not. If it happened, if it was incurred, you record the wages expense. Well, then what do you credit? Well, you owe them, right? So you're going to credit wages payable. Now, what would happen if you didn't do this entry? Well, if you didn't do this entry, your wages expense would be understated. So your expenses would be understated. If your expenses are understated, your net income will be overstated. So your income statement is going to be off unless you do this adjusting a journal entry. Likewise, if you don't recognize the payable, then you're not going to put wages payable in the liability section of your balance sheet. So your liabilities will be understated. You see how these adjusting entries bring all of the balances where they need to be so that you'll have good numbers for your income statement and your balance sheet. Now, that is the basic theory that we teach you in financial accounting. Now let's go to Mookie. Okay. Now in EM 9-3 on page 461, you're supposed to prepare an adjusting entry for prepaid insurance. Okay, well, this is fine so far. Mookie purchased a $300 insurance policy. Okay, so what did I tell you before? That when you buy an insurance policy, you own that policy, and you're supposed to debit the asset prepaid insurance, right? Well, Mookie didn't do that. You say what? No, Mookie expensed the whole amount. So this is what Mookie did. Instead, they just expensed the whole policy to insurance expense. So that's kind of wacky, isn't it? Well, at the end of the period, they say that, well, only $100 has expired. So we need insurance expense to be 100, not 300. So what we have to do is the unexpired amount, the 200 that it hasn't been expired yet, we've got to take it out of insurance expense and put it into the asset prepaid insurance, because the $200 is unexpired. So that's how Mookie does it, right? So what's the journal entry? Debit prepaid insurance by 200 and credit insurance expense by 200. That is so weird, huh? It works though, because at the end, don't you want the unexpired prepaid insurance balance to be 200? Yeah. And so notice here that the expired, they said $100 expired. Well, 300 minus 200, the balance here would be 100. So it works, just a little bit wacky. Okay. All right, let's move on to the next one. This is EM 9.4, adjusting entry for supplies. This is on page 462. Mookie purchased $1,185 of supplies. Okay, now, when we buy supplies, we should be debiting the asset supplies, right? But guess what? Mookie expensed the whole amount. Say what? Well, that's what Mookie did. So that's what they did. They put all of the that cost into supplies expense. Well, at the end of the period, Mookie still has $685 of supplies on hand. So this is not all expense. There's $685 that was not expense. So we have to move that unexpired amount, the supplies on hand, out of the supplies expense and put it back into where it belongs, into the supplies account, 685. So what is my adjusting journal entry? Debit supplies, 685. Credit supplies expense, 685. I know it's wacky, but it works, because the ending balance is in supplies is 685, and that's what we have supplies on hand. So it does work. It's just a different way of doing it. And you can see why I took the time to do this PowerPoint presentation for you, so you can understand what's going on. Because I'm sure that you learned it the traditional way. Let's do EM 9.5. Adjusting entry for prepaid rental on page 463. And man, I'm just going to give you the answer on this one, because this one is like two entries in one. And I'm just going to kind of go through it. You can read your book and look at it, but this is kind of how I interpret it so you can understand what's going on. And I do give you the answer at the end, but some of you guys are having inquiring minds and saying, what the heck? What's going on here? So this is what's going on. Mookie merges two entries into one. First, Mookie paid $900 rent in advance using a credit card. Well, we know that if you pay rent in advance, it should be prepaid rent. It should be an asset, right? Prepaid rent. But not Mookie doesn't do it that way. Mookie expensed the whole amount. Really? Yeah, that's what Mookie did. So we're putting that entire rent in advance under an expense of $900. Logically, the way we were trained, and theoretically, it should be prepaid rent, but we're going to expense it all, okay, and then fix it later. Okay, and then how do we pay it? With the Visa credit card. Okay, then Mookie said that, well, there's 750 of this 900 that's unexpired. Well, we've got to take it out of the expense if it's unexpired and put it in the asset account, prepaid rent, right? So we're going to take that 900 of the rent and lease expense. We're going to take 750 out of the expense because it wasn't expense, and we're going to put it in paid rent. So that is really what's going on. Now, what the author did is they combined these two entries into one. So have you noticed here that, you have rent and lease expense of 900 in this entry, but then when you move that unexpired amount into prepaid rent, then you credit the rent and lease expense. The net of these two is $150. So in the solution and in the journal entry that you're going to be putting in the QuickBooks, you're going to net these two together. So you're just going to use one instance of rent and lease expense of $150. And it's going to look like this. Okay. So rent and lease expense, $150, right? Because we're combining the 900 debit and the 750 credit. So just one instance of rent and lease expense. And then we'll put the other ones in, the reclassification back into prepaid rent, and of course the Visa credit card. This is the solution. This is the journal entry that you will be putting into QuickBooks. If I was the author, I would not go this far because this is pretty intense. This is not just adjusting journal entry. There's two things going on here. Matter of fact, just in my own simple mind, I would do them separately so that I could see it more easily. But anyway, this is the answer and you can study it. But definitely, I wanted to share this with you so that you won't get stumped and just get frustrated because you can't understand what the heck's going on. This is the answer. Okay. All right. Let's go on to EM 9-6. This is the entry for unearned revenue. Okay. So Mookie received a cash advance of $3,200 for pet care services. So Mookie received the cash advance, but we haven't done anything for it yet. So we owe the money, right? Well, we are trained then to record that cash advance as the liability unearned revenue, right? So we would put it in the credit as a liability, but not Mookie. Oh no. Mookie recorded the whole cash advance to sales. My gosh. Okay. It's just a different way of doing it. It will work. But now, at the end of the period, we know that of that 3,200, 2,000 of the cash advance remains unearned. So we've got to take it out of the sales, right? By debiting sales and put it into the unearned revenue as a liability. Because remember, this $2,000 is a cash advance that remains unearned. We still owe it. So we're transferring out of sales and putting it into unearned revenue. Now, when we do that, well, let me show you the journal entry then. You're going to debit sales for 2,000. You're going to credit unearned revenue for 2,000. And notice here that, yeah, it's great because it works out, because we know that at the end, we have $2,000 that remains unearned. So we need to make sure that our liability is 2,000. And also our sales will be correct, because, you know, Mookie did put in 3,200, but then backed out the part that's unearned. So then this $1,200 balance, well, that's what was earned. So we're all good. It's just a wacky way of doing it, right? All right, very good. Mookie has incurred interest that has not been recorded or paid. Okay, I'm just going to share the entry with you. This is what you're going to put. Debit interest paid, $5. Credit interest payable, $5. That's going to be the answer. I'm giving you the answer. But the thing is, theoretically, it shouldn't be interest paid. It should be interest expense. However, the book is using a predefined QuickBooks account called interest paid. So we're going to go with it. Okay, I know it's supposed to be interest expense, but the author just said, let's keep it that way. Matter of fact, in the updates, she says something about that. Yeah, theoretically, it should be interest expense, but let's keep it interest paid because we're using that predefined account. Okay, just go with it. All right, very good. In EM 9.8, we're going to do some accrued expenses. So Mookie overlooked paying contractor Evan Henry for providing pet care services totaling 24 hours at $20 per hour, which is $480. So I'm going to give you the answer here, and we'll talk about it. You'll be debiting contractor's expense of $480 and crediting accounts payable. Now, the thing is, you have to remember to put Evan Henry's name in the accounts payable line. If you don't, you're going to get an error message. Anytime you use accounts payable, you just can't say credit accounts payable or something. You've got to say, well, whose accounts payable is it? What vendor is it? Well, in this case, it's Evan Henry. So here, in the accounts payable line, this account 2001, you're going to put Evan Henry as the vendor. And when you do that, and matter of fact, this is what your entry is going to look like for adjusting entry 6. I gave you the answer. Here it is. You'll accept it, and you'll be fine. Now, in the next one we're going to do, you're going to have to add a vendor. In 9.9, you're going to have to add a vendor. So I'm just going to tell you how to do it because I like this little graphic here. You can just go down to the down arrow and say add new, and you can add a new vendor on the fly. So that's what you're going to do in the next one. So let's see what I'm talking about here. Okay. Now, Mookie incurred $330 of accounting services. The amount has not been paid or recorded. Okay, fine. Well, it's for accounting services, so we're going to debit legal and professional fees of $330. And we have to credit accounts payable, but it just can't be accounts payable. You got to define it to a certain vendor. And this is what's really screwy about it. They don't even tell you to do that in the book. And they don't even tell you about a vendor. So I just made this one up. I added Sally View CPA. So you can do that too. Just put Sally View as a vendor. Now, you can add Sally View CPA on the fly. What I mean by that? Well, you can click on the name field as you did for Evan Henry, but this time you'll select the add new. And I'm going to show you the next slide, what the vendor screen will look like when you add Sally View. But once you add Sally View's name to the accounts payable line, as you did for Evan Henry, you're good to go. You can save it and you did it. Okay, well, I just want to show you how simple it is to put in the information to add Sally View CPA as a vendor. Oh, here it is. You're supposed to go credit of 330. Okay, here we go. Yeah, add Sally View. You just put in the company name, Sally View CPA. And I think if you do that, this will automatically display, and that will automatically display, and just hit save or whatever it is, and you're done. So that's all you need to do. It's pretty easy. I'm glad I shared that with you, because I know that I'd be getting like, 60 students saying, hey, what's going on here? So now you know what's going on. So, all right. Last one, the adjusting entry for renter insurance. So Mookie discovers an $18 receipt for renter's insurance that has not been recorded. Matter of fact, in the book, they talk about that receipt being in somebody's pocket, and they just forgot all about it. So now they've got to record it. Okay, so this is what we're going to do to record it. A debit renter's insurance for 18, credit the Visa credit card, because we're going to pay it with the Visa credit card. Now, I think the in your homework, they're going to ask you, well, how can you avoid missing items that you forget to put in or you overlook? Well, there's two ways. You can use the QBO mobile app. So you can enter your receipts on the go. So you don't have to wait to record the receipts until you're back in the office. Using your phone right in the field, you can put that receipt in and make sure it's in there, right? Another way to control missing items is to use the bank match feature. And that we discussed that in the banking chapter, where we download bank and credit card transactions. Then we'll match those transactions with what has been entered in QBO. Okay. Now, for the transactions on your bank and credit card statements that can't be matched with QBO transactions, well, then they must be missing, and you can add them to QBO. Okay. Let's talk about the steps in the accounting cycle. Might as well. Now, in your textbook, they talk about, the chart of accounts, adding to the chart of accounts as part of the accounting cycle. This textbook is the only one that I've ever heard of the chart of accounts being part of the accounting cycle. But nevertheless, I'm just going to show you traditionally what it is. This is a great illustration here. It's found in our Accounting 4A textbook. We start out by analyzing transactions, and then we journalize those transactions. Now, in QuickBooks Online, there's two ways to get those journal entries. One is through on-screen forms, like, you hit the bill form or the expense form, whatever you're doing, and you enter the information, and then behind the scenes, that form will create a journal entry for you. So those are online screen forms. Will create the journal entry. Or you can do what you're going to do in this chapter and go right to the journal and put in your adjusting journal entries and put those journal entries right into the journal. Okay. The next thing that has to happen in any manual system or computerized system is those journal entries have to post to the ledger. Now, what's interesting about QuickBooks is as soon as you hit accept in an on-screen form, or you hit accept for a journal entry in the journal, it's going to post automatically for you. Now, not all computerized systems work that way. So like in Sage 100, you'll enter your information in online forms, all right, but it's going to hold it in a register and holding place until you look at it and say, okay, I'm ready. I want to post it. And then you'll post it. So you have to physically post it. But in QuickBooks, as soon as you accept the form or you accept the journal entry, it'll post for you automatically. Now, at this point, you're going to have the ending balances put over to a trial balance. Now, this trial balance is before adjusted entries, so they may not be up to date. So what we're going to do is use that trial balance to see if any of these accounts need to be updated for, so let's say that we have, $9,720 in supplies, but do we really? If we counted them, we may have used some supplies. So what we'll have to do is we'll have to make an adjusting journal entry to reduce that supplies balance. So we're going to recognize the expense and recognize that we used up those supplies. And then we have a correct balance, right? An updated balance. That's the final balance that's going to go on our financial statements. So when we do all of our adjusting entries and we post them, now we run another, what we call an adjusted trial balance. And that's the numbers that we use to prepare our financial statements, which would include the income statement, the balance sheet, and here they say the statement of retained earnings, which is kind of go between the income statement and the balance sheet. Traditionally, if you push me into it, what are the three main ones? Balance sheet, income statement, and statement of cash flows. But right now, the overall picture is from the adjusted trial balance, we prepare our financial statements. Now we're done. We're done with the financial statements. We need to prepare the accounts to start a new period. So you need to close temporary accounts. And the temporary accounts are, and I remember this using the slogan red, revenues. R is revenues, E is expenses, and D is dividends. So we're going to close revenues, expenses, and dividends. Now, why do we close them at the end of the period? Well, because you want to get ready for the next period. Let's say that this is December 31, 2022. Do you want 2022 revenues in 2023? No. So you close them out. And so then when you move on to January 1 of 2023, you're starting over. Revenues will be zero. Do you want 2022 expenses in 2023? No. So you close them out, the 2022 balances, and you bring forward the expenses. But the expenses will start over. They'll have a zero balance. Now, in QuickBooks, we don't have to do the journal entries. Like, we trained you in financial accounting to close revenues and close expenses, close income summary, and close dividends, and this whole rigorous process. But in computerized systems, basically you say, I want to close, hit the button, and there it goes. It's pretty slick. You probably ask yourself, if it's that easy, why did you put us through all that pain? And to learn this, well, you've got to know what's going on behind the scenes, right? But in real life, in a computerized system, basically like in Sage 100, you want to close, hit the button, it closes it, and you're done. Now, in QuickBooks, what you do is you set up how you want it to be closed and when you want to close them, right? So anyway, it'll set it for you automatically, and you just let it alone and it'll do it, right? So then after you close the books, you're ready to start over again. Well, then you'll have a post-closing trial balance. And remember, all you'll have there is balance sheet accounts. Those are permanent accounts. And the temporary accounts, the revenues, expenses, and dividends, they'll have zero balances. But once you do that, you can then start over with analyzing the transactions and journalizing and do the whole thing again. And generally, we do this every month. So, but it's really handy to do this cycle using the computer. Okay. All right. That ends this portion of the program. So I hope you enjoyed it. I'm going to stop the share. So you have a good time working with Chapter 9 and study hard. Talk to you later. Bye-bye.